For the first time in over a decade, the average FICO score in America just dropped from 718 down to 714. And if you think that 4-point dip doesn't affect you, you're about to learn why this small number could cost you thousands of dollars. Welcome back to Credit Unlocked. I'm looking at the latest FICO data, and something unprecedented just happened. After rising steadily since 2010, the national average credit score has officially reversed course. We're now at 714, down 4 points from last year. This isn't just a statistical blip. This movement tells us something important about the financial health of millions of Americans. So why did this happen? Three main reasons. First, credit card debt has surged to over $1 trillion nationally. That's trillion with a T. More people are carrying balances month to month, and that utilization ratio is dragging scores down. Second, inflation pressures have forced more people to miss payments or pay late. Even one 30-day late payment can drop your score 40 to 100 points. And third, there's been a significant increase in new credit applications as people try to manage rising costs. Here's what most people don't realize. When the average score drops, lenders tighten their standards. They become more conservative. That means even if your score stayed the same, you might now need a 740 score to qualify for that 0% APR card that only required 730 last year. Or you might get approved for a car loan, but at a higher interest rate. Let me give you a real example. Say you're buying a $300,000 home with a 20% down payment. Last year, with a 740 score, you might have qualified for a 6.5% 30-year fixed mortgage. Today, with lenders being more cautious, that same score might only get you 6.8%. That extra 0.3% adds up to over $18,000 in extra interest over the life of the loan. So what should you do right now? Step 1, check your credit utilization. This is the percentage of your available credit you're using. If it's above 30%, you're hurting your score. Pay down those balances or request credit limit increases to lower that ratio. Step 2, set up automatic payments for at least the minimum amount due on all your accounts. One missed payment in this environment could be devastating. Step 3, be strategic about new credit. Every hard inquiry typically drops your score 5 to 10 points. In a tightening credit environment, those points matter more than ever. Only apply for credit you genuinely need and space out applications by at least 6 months when possible. And here's a pro tip. When you do apply, do it within a 14 to 45-day window. Most scoring models count multiple inquiries for the same type of loan, like a mortgage or auto loan, as just one inquiry if they happen within this shopping period. Now, here's the most important question. Should you panic if your score dropped along with the national average? Not necessarily. If it dropped a few points because of increased utilization or a new inquiry, that's fixable. But if your score dropped 20 plus points, you need to check your credit reports immediately. Look for errors, fraudulent accounts, or incorrect late payments. You're entitled to free weekly reports from all three bureaus through annualcreditreport.com. Remember this, credit scores move in cycles. We had 14 years of rising scores, and now we're seeing a correction. Your job isn't to beat the national average. It's to understand how these trends affect you personally. A 714 average means there are millions of people with scores both above and below that number. Where you fall on that spectrum determines what financial opportunities are available to you. So I want to hear from you. Has your credit score changed in the past year? And if so, what do you think caused it? Drop your experience in the comments below, and if you found this breakdown helpful, hit that like button and subscribe for more credit insights every week. Until next time, keep unlocking your credit potential.